What are some strategies or tips for investors to protect their portfolios from the U.S. debt ceiling crisis? Suggest some ways to diversify, hedge or adjust their investments to reduce their exposure to the U.S. debt risk and take advantage of opportunities in other markets or sectors. The U.S. debt ceiling crisis is a situation where the U.S. government may not be able to pay all its bills on time if Congress does not raise the limit on how much it can borrow. This could have serious consequences for the U.S. economy and the global financial system, such as a default on U.S. Treasury bonds, a downgrade of the U.S. credit rating, a spike in interest rates, a stock market crash, and a recession. As an investor, you may be wondering how to protect your portfolio from the potential fallout of the debt ceiling crisis. Here are some strategies or tips that you may consider. First, don't panic. While the debt ceiling crisis is a serious threat, it is not inevitable. There is still a chance that Congress will reach a deal to raise the debt limit before the deadline, or that the Treasury Department will find ways to extend its cash reserves. Panicking and selling your assets at a loss may only hurt your long-term returns and lock in your losses. Second, prepare mentally for investment declines. If the debt ceiling crisis does happen, you may see your portfolio value drop significantly in the short term. This can be stressful and scary, but you should try to keep calm and focus on your long-term goals. Remember that market declines are normal and temporary, and that historically, markets have always recovered from crises over time. Third, bolster your cash emergency funds. Having enough cash on hand can help you weather any financial storm and avoid selling your investments at a low point. You may want to increase your cash savings to cover at least 6 months of your essential expenses, or more if you have a low-risk tolerance or depend on income from your investments. Fourth, have a long-term investment strategy. Having a clear and diversified investment plan can help you navigate any market turbulence and reduce your exposure to any single risk factor. You may want to review your asset allocation and make sure it matches your risk profile, time horizon, and financial goals. You may also want to rebalance your portfolio periodically to maintain your target allocation and take advantage of market opportunities. Fifth, if you are a government employee, Social Security recipient, and/or Medicare beneficiary, you may want to plan for a pause in payments. If the U.S. government runs out of money, it may have to delay or reduce some of its payments to its employees, retirees, and beneficiaries. You may want to prepare for this possibility by having an alternative source of income or cutting back on your expenses until the situation is resolved. Sixth, be prepared for increases in borrowing costs. If the U.S. government defaults on its debt or has its credit rating downgraded, it may face higher interest rates when it borrows money in the future. This could also affect other borrowers in the economy, such as corporations, consumers, and homeowners. You may want to pay down any high-interest debt you have or refinance your mortgage or other loans at a lower rate before the crisis hits. Seventh, haven't yet started Social Security or Medicare? Consider delaying them. If you are eligible for Social Security or Medicare but haven't yet claimed them, you may want to wait until the debt ceiling crisis is over before starting them. This could help you avoid any disruptions in your benefits or payments, and also increase your future benefits by earning more credits or delaying retirement. 8. Look for opportunities in other markets or sectors. While the U.S. debt ceiling crisis could hurt the U.S. economy and markets, it could also create opportunities in other regions or sectors that are less affected by it or benefit from it. For example, you may want to invest in foreign stocks or bonds that offer higher returns or lower risks than U.S. ones, or in sectors that are more resilient or defensive in times of uncertainty, such as healthcare, utilities, or consumer staples. These are some possible ways to protect your investments from the U.S. debt ceiling crisis. However, you should always consult with a professional financial advisor before making any changes to your portfolio based on your specific situation and goals. Thank you for watching this video. Please like, share, and subscribe for more content like this.